Hi everyone, this is Stephen Elwell, the Chief Investment Officer of Level Financial Advisors, and this is your fourth quarter 2018 market review. Needless to say, the fourth quarter of 2018 was not a good one for the stock market. The U.S. stock market dropped about 14%. International stocks lost a little less than that. Emerging markets and global real estate held up a little bit better, but we're still down about 7 and 6% each. Meanwhile, the bond market finally had a nice recovery and provided a nice cushion for portfolios while the stock market declined. And of course, this is a major reason of why we own bonds, is to be able to provide that cushion when the stock market goes haywire temporarily. And it does a really nice job of sort of dampening the volatility and providing an area where we can get money for any cash withdrawals that someone needs without having to sell stocks while they're temporarily lower in prices. So the quarter, like I said, was not a good one for the stock market, but when you take a look at the longer term picture, if you look out over the last year and 5 years and 10 years, you can really see that while short-term declines like this tend to happen and actually are fairly normal, usually there's one or two 5 to 10% declines in the stock market just about every year. This year there happened to be a 20% decline within the calendar year, which is the worst since 2009. And the year-long return for the U.S. stock market was the worst since 2008. But having said that, still looking at the 10-year returns for whichever category of stocks you want to look at, U.S. stocks, international stocks, emerging markets, real estate, all of which look really good, and even the bond market has reasonable returns over those periods. So the big picture really is to ensure that while nobody likes to see their portfolio go down temporarily, and it can certainly be uncomfortable, especially if it's right at the moment where a major life event like retirement is happening. The context really is, if you're taking a longer picture view, much of what's been lost is just simply what's been gained within the last 18 to 24 months. 2016 was an excellent year. 2017 was even better. And so, like I said, while it's never fun or comfortable for anyone to see their portfolio go down, a lot of what people are losing is just some of the profits that they've made in the last 12 months and 18 months. Having said that, we're recording this on January 9th of 2019, and there's been a really nice rally so far in 2019, which means some of what has been lost over the last couple of months has been gained back within the last 9 days. So we always encourage everyone to take the big picture view. None of you should be investing for the next 3 months, 6 months, 12 months. Your investment time frame is likely decades, and you're not forced to sell at these low prices. That's like I said, the whole reason why we like to own some portion of your portfolio in bonds, so we can have a place to get money whenever the stock market goes haywire like this. Along with that, if you're not taking any withdrawals, if you're making deposits, then obviously it's a good time to make those deposits, because we're able to take advantage of lower stock prices. On top of that, if you're not making any deposits and the portfolio gets far enough out of line, then we will rebalance it to take advantage of these lower prices. So there can be opportunity when the stock market has declines like this. I know Warren Buffett's famous for saying that stock market declines really are the best thing that can happen for an investor like him who has a really long time frame. And anybody that has any portion of their money in the stock market should have a time frame that should be able to take advantage of these type of declines. So we always want to point that out. So what really caused the stock market to have this decline in the fourth quarter? Well, there really are a lot of different things that are going on. First off, there's a government shutdown, which generally tends to be, it's not the first time it's happened, but generally tends to be short-term in nature, and one would expect at some point some type of compromise is reached and the government comes back online. So that's one that certainly makes the stock market a little nervous because there's some uncertainty there. There's been ongoing uncertainty around a U.S. and China trade deal, and the question of whether they can come to a deal, have a compromise, and work it out is an important one because we're talking about the two largest economies in the world. So obviously, if they stop trading with each other or slow down trading with each other even, that's going to have a ripple effect not through just those two economies, but the rest of the world. So the longer that sort of standoff goes on and this tit for tat with slapping higher tariffs on each other, the longer that goes on, the more it's going to make the stock market nervous because we're talking about the two biggest players in the world. The good news is, like I said, we're recording this on January 9th, and there's been 3 days of meetings that they've had, so we'll wait and see exactly what comes out of that, if anything. But should they reach some type of an agreement, one would expect that the stock market would find that to be favorable news and expect some type of rebound. There are two other issues out there that's causing the stock market to be concerned, and one of which is rising interest rates. The Federal Reserve again raised interest rates 0.25% in December and did say that they expected to raise rates a couple of times more in 2019. I think the market was looking for a softer stance where the Federal Reserve might say, we'll wait and see how things turn out, but not expecting any type of increases in 2019. The reality is, while there have been a few manufacturing reports that indicate a bit of a slowdown in the economy, the stock market certainly is expecting a slowdown in the stock market, in the economy. But the rest of the economic data hasn't yet really shown that that slowdown is happening, and certainly hasn't shown that a recession is on the horizon. And that'll be the ultimate determinant of whether this is a short-term decline that fully recovers quickly or is something that potentially drags on for a while, will be what does happen with corporate profits in the economy. Is the slowdown worse than expected? Does it turn into a recession? And if so, how deep and how long does that recession last? It wouldn't be abnormal to have a recession that comes down the line when you think about it from a business cycle standpoint. I mean, it's been since 2008 that we've had a recession. So from the economic standpoint, the prospect of the Federal Reserve continuing to raise interest rates and pairing that with a government shutdown, dragging out of a trade deal with China, and a potentially slowing economy, obviously that's a lot going on for the stock market to digest, and that's kind of where you're seeing a lot of the volatility over the last couple of months. The good news is, when you look at current stock prices, and the prices that came through the fourth quarter. I mean, as an example, 3 of the largest stocks in the U.S. Amazon at one point was down 34% from its high. Apple was down 39% from its high. Facebook was down 43% from its high. And this is one of the things that we talked a little bit about over the summer through some of the blog posts that we wrote, was the U.S. stock market, specifically big U.S. stocks, and specifically those of tech companies, were really reaching sky-high valuations, which doesn't necessarily mean the stocks have to drop, but the expectation for how well those companies were going to do was very, very high. And obviously, as Apple and Amazon and Facebook started to revise their earnings and make announcements about what was happening with some of their orders, became clear that those expectations were too high. And this is something that we kind of warn about, because a lot of times there'll be one category of investments, whether that's big U.S. stocks or anything else. Lately, it's been big U.S. stocks that does really, really well. And as humans, we tend to focus on what's been doing well recently, and we want to own more of that. Well, the reality is no one thing does the best forever. That's just not the way the investment world works. It can't work that way. If it did, there would be no investment industry at all. We'd all just buy that one thing. And so what ended up happening is big U.S. stocks ended up going down quite a bit more than just about every other stock category in the fourth quarter. And part of the reason, along with all the concerns that were out there, was just simply because the expectations and valuations on that category of stocks was so high compared to everything else. And many of you noticed that international stocks have been down, basically since the middle of the year, while the U.S. stock market ended up reaching highs all the way through the end of September. And small stocks, had a big decline for the fourth quarter, and that makes sense because small companies can be more volatile than big companies. But that's kind of another reason where you see emerging markets that held up reasonably well within the fourth quarter on a comparative basis, anyways, was because that risk of a slowing down environment was already priced into emerging market stocks. So these type of reversions back, where things start to come back into the averages, is fairly normal, and so that's why you always want to be careful when you see one category start to really outperform others. It doesn't mean that outperformance in that category can't continue. It just means you probably ought to be careful about thinking you should add more to a place that's already been doing better, because the risk is at some point that'll probably come back in line, and you certainly don't want to be buying something right at its peak. So when we look at valuations in the U.S., they now actually don't really look that bad. When we look overseas, things look even better, and this is something we've talked about in the past. I mean, if you're looking for a place that's really beaten down, international stocks and emerging market stocks appear to be, some of the most attractive places that you could be if you were looking to invest in stocks. So rebalancing into categories like that, if they're underweight, can make a lot of sense for our portfolios, and maybe something you'll see us do over the course of the year, depending on how far things get out of line. The last thing we really want to touch on is, we kind of want to reiterate the last time there was a decline this large, 2008, and this isn't anywhere near where that was. And many of you would probably agree. You can remember what the headlines were back then. I mean, banks were failing, and there was constant news of how many people were losing their jobs in the millions. So this isn't anywhere near to that extent. But one thing that's worth pointing out is the people that panicked and sold their stocks while they were low and either got in a little bit later or never got back in really suffered over the last 10 years. They certainly did not make back what they could have made if they just simply stuck with it. And we absolutely recognize how difficult it is to stick with the game plan, but you have to remember that these investment portfolios were built specifically for what your personal financial plan is. So making changes based on a nervous feeling or a gut feeling or some type of prediction that you read on the financial media is a really dangerous move, because you can, number one, nobody can predict the short-term future. Number two, as smart as people sound on TV and when they write articles that really grab your eye, it doesn't necessarily pertain to your situation, and it doesn't mean that even if they're making a smart argument that it'll come true. I mean, there have been plenty of times in history where very smart people have actually kind of foreseen and predict what's going to happen, but investment-wise, their theory that they would have implemented still would not have panned out, or would have only panned out over a short period of time. And you find that when you think about people that potentially make changes in their portfolio and say, well, I'm going to get out now and I'll get back in when things look better. Well, to be honest, when things look better, stock prices will have already recovered. So what you're in essence saying is, I want to sell at a low price and buy back in at a high price. And in no way does that make any investment sense at all. That is the exact opposite of what we're supposed to do. So we certainly recognize that it's an uncomfortable moment. We definitely encourage you to call, to email, to schedule meetings if you're nervous, so we can talk through what does this recent decline mean for me. What, if anything, should we do with the portfolio to take advantage of this recent decline? And what impact, if any, will it have on my long-term financial future? So by all means, if you have any questions or if you have any concerns, we always want you to know we're here. Reach out. Talk to your advisor. We're absolutely ready and happy to help. So this has been the fourth quarter 2018 recap. I'm Steve Elwell from Level Financial Advisors, and I look forward to talking to you guys soon. Thanks.